I think it is beginning to turn heads. If you look at 3-year moving average, Bitcoin has gone up every year. And I think it's just becoming undeniable that it is a force that especially now that institutions have to consider it. We showed the correlations of returns. The correlations with other assets, still very low. It's absolutely essential that institutional asset allocators take a look at this asset.
Cathie Wood argues that Bitcoin is beginning to command serious attention, particularly from institutional investors. One of the key reasons for this shift is Bitcoin's consistent upward trend over time, even when viewed through a 3-year moving average. Unlike many traditional assets, Bitcoin has maintained a low correlation with other asset classes, making it an essential consideration for institutional portfolio diversification. Wood emphasizes that ignoring Bitcoin is a failure of fiduciary responsibility for asset managers.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
I think it is beginning to turn heads because, you know, if you look at the, I think it's not even the 4-year moving average, which would capture the cycle, but the 3-year moving average. Bitcoin has gone up every year if you're using a 3-year moving average. And I think it's just becoming undeniable that it is a force that especially now that institutions have to consider it as a new asset class, because we've also put out there, I actually put it out in 2016, Bitcoin ringing the bell for a new asset class. We showed the correlations of returns. The correlations still, even though traditional investors are getting involved, the correlations with other assets still very low. It's absolutely essential that institutional asset allocators take a look at this asset. If they don't, they're not doing their fiduciary responsibility. So we're trying to help ease them, provide a bridge. Okay, we're talking your language. Bitcoin is not only a technology. It's not only one of the biggest ideas ever, you know, the global monetary system, rules-based, digital, private, all of that, but it is a new asset class. And when you present investors with those three and they're not knowledgeable enough, it's a little bit threatening, or they feel a bit vulnerable. So we are trying to bridge in with, okay, we're going to talk your language. You need to look at this new asset class. There are 50 bills going through 22 states right now around Bitcoin reserves. So that's very interesting. Texas, Arizona, and Utah, I think, have seen progress within the last week, which is very exciting because Texas and California, each of those states is bigger than Canada. And of course, Canada is huge in terms of a gold resource base. Big ideas, 2025. And we've become fascinated with the convergences among all of the technologies around which we have centered our research. So we've centered our research around the 5 major innovation platforms evolving today. So as you said, Anthony, robotics, energy storage, artificial intelligence, blockchain technology, and multi-omic sequencing in the life science space. AI, if you look at the convergence chart in that deck and compare it to the one we put in last year, what you see are the convergences are intensifying with AI really the heartbeat of convergence, pushing everything along and accelerating the pace of change, and also accelerating the deflationary undercurrents. And I know this is very controversial, but accelerating the deflationary undercurrents that we believe are going to intensify. Deflation, not bad deflation, good deflation. When you cut prices, you enable more access, right? So if you look at the convergence chart, we've focused, of course, on blockchain technologies and agentic AI. I think if he only has 2 years before he effectively becomes a lame duck, and he knows that, which is another reason I'm posting this, because, let's get this thing going as quickly as possible. If we said, we're taking your tax rates down, choose a percentage, 3 percentage points, retroactive, if they did this very soon, to, February 1st, or March 1st, let's say, and they finish the negotiation. That would take the uncertainty away. That would take that very important uncertainty away. And honestly, I think we will have a booming economy with much lower than expected inflation, because the productivity gains, after we've been through this rolling recession, and now here's the last leg of it. We were housing, autos, capital spending, small businesses creamed, lower income creamed, finally high income cracking. We're ready for a massive productivity increase, which, I learned again in the early 80s so much. Productivity increases and a rising dollar are two of the biggest antidotes to inflation. And I think we're going to be shocked at how low inflation goes.
Wood points out that increased productivity and a strong dollar were two of the most powerful deflationary forces of that era. The Federal Reserve's aggressive rate hikes since 2022, raising rates 24-fold in just over a year, were unprecedented and have caused significant economic stress. However, Wood argues that as different sectors adapt and productivity gains take hold, inflation will not only moderate, but could decline sharply. Meanwhile, consumer behavior is shifting in anticipation of lower interest rates and falling prices. Wood notes that individuals and businesses are delaying purchases, waiting for better deals. This behavior, combined with a slowing economy, supports her thesis of a disinflationary or even deflationary environment in the near future.
So the velocity of money is the rate at which money turns over. Now, in an environment of fear, which is what we have right now, in an environment of fear, what do people do? Well, you've got, I'm going to say 30% of the labor force, which is in either government or quasi-government, including healthcare, education, and so forth. 30% or more of the labor force is saying, am I going to have a job? How is this going to filter down to the state and local sector? That's where the bulk of the jobs are. So there's fear. And that will slow the velocity of money down. So it hit me when Walmart came out and said, 2025 is going to be a big slowdown. Last year they had 5% same-store sales. Now they're saying it's going to be 3 to 4%. So that's a 30% deceleration in the growth rate. So that's a change and a change. So that's, for them to be so sure now, they're seeing something they do not like. So part of it is fear, but there's another reason people will delay purchases or business activity. If they think their tax rates are going down, and again, lesson from the early Reagan years, if they think their tax rates are going down, they're going to wait and hold off on a lot of activity until they understand what that means. And if you listen to Kevin Hassert recently, he's been talking about the quid pro quo between tariffs and taxes. What that means to me, given that Art has been an advisor to every president with the exception of 2 in the last, I'm going to say 30, 40, 50 years, is that we're moving towards a flatter tax system and lower rates for everyone. That's Reagan revolution. Reagan delayed the impact. The full 25 percentage point reduction took 3 years. The economy fell into 2 recessions. Why? Well, there were a lot of other reasons, but we learned very quickly in 1983, oh my gosh, we went into a boom. They were all waiting for that last time. So you've got fear of unemployment. You've got, wait, how much of a better deal am I going to get out there? And the same thing with pricing. If people think prices are coming down and interest rates are coming down, as President Trump is telling us, and long rates have started coming down. Nobody believed that was going to happen. They're going to hold off for the lower rates and lower prices. So those are 3 delays. Now, what does this mean? Today, we got Atlanta's GDP now estimate is negative for the first quarter. Negative GDP. Now, we have been saying, and many people didn't agree with this point of view, but I think it's playing out now. We've been in a rolling recession since the Fed started raising rates in 22. It jacked them up at a record-breaking pace. We've never had anything like that. You go back to Volcker, everybody remembers 20% interest rates. Yeah, went from 10 to 20%. That's a 2-fold increase. We went up 24-fold in little more than a year's time. That was a major shock to the system. And I think we have been one sector after another moving down. The one that did not capitulate was the consumer. And it did not capitulate because of the high-end consumer. Well, guess what? In the last University of Michigan consumer sentiment survey, the high-income earners' confidence cracked. So I think we're going to see a completely different tune in the next few months.
Cathie Wood's perspective offers a bold counterpoint to mainstream economic narratives. She paints a picture of an economic landscape that is evolving rapidly, driven by technological convergence, AI-led productivity growth, and shifting macroeconomic conditions. Bitcoin is emerging as an undeniable force in institutional finance, while AI is fueling innovation and deflationary pressures. The economy, though currently in a rolling recession, may be on the cusp of a significant transformation provided policymakers take the right steps. Please like and subscribe.